So I think maybe one place to begin for this crowd is to talk a little about, when you were a child, did you want to be an investment banker?
I actually wanted to be a chef, if you really want to know.
So how did you go astray?
I went stray based on probably my student loans and the idea that actually opening a restaurant 30 years ago was not a very good business proposition. So when I came out of college, I was an economics and political science major. I was a liberal arts background. I actually only took one accounting class, which is interesting given my seat today. But I went to Wall Street because I wanted to learn about business. I like the fast pace, the smart people. I went there thinking I would pay off my loans and then go be a chef, which is what I did to make a little bit of money in college. And lo and behold, 30 years later, I'm still here.
So why? I mean, you still could have gone back.
I could have.
You could open that restaurant.
I do. I make a mean brunch. Again, I think professionally, I've asked myself every 3 to 5 years, I ask the same question. I ask myself, 1, do I like what I'm doing? Is it interesting? Is it challenging? 2, do I generally like the people I work with and the firm I work for? And then 3, do I think I get recognized for my contribution? And if the answer to those questions, 2 of those 3 questions are yes, I put my head back down and I work for another 3 to 5 years, which I would strongly encourage all of you to do. The number of people who come into my office after 6 months in their job and say, what's next, I'm ready to go. But I think that's the younger generation today. And so I've really been challenged. It's been interesting. As you said, I was a banker for 25 years. 4.5 years ago, our CEO asked me to be the CFO, and it's been a fantastic experience and a really interesting seat to sit in.
So from where you sit, I think you have kind of a unique look at the economy. And I think this is a crowd that doesn't think every day about the economy, perhaps, but we're all thinking about the economy. And of course, there's talk about recession and all that sort of thing. What's kind of your general take about what's out there in terms of the financial outlook?
Yeah. Well, there's a lot out there, and there's a lot of people who like to tell you exactly what's going to happen. I'm going to give you my sense because it's really hard to figure this thing out. But I would say you got to separate a couple things. You got to separate the data from the sentiment. And if you look at certainly the U.S. data is actually quite good. Whether you look at jobs, employment data, wage growth, and even the growth numbers are actually pretty good. What we're seeing some weakness in is some of the confidence numbers, some of the manufacturing numbers. But I think all of you know from a U.S. perspective, 70% of the economy is driven by consumers. The consumers are healthy. So the U.S. data is actually quite good, and then we obviously have the Fed easing to try to make spur investment and continue the growth that we're seeing. I think globally it gets a little bit trickier. Europe is clearly slowing. Brexit is causing people some concern, as well as just the export and trade tensions around the world. So I would say the European economy, particularly Germany and some other countries, actually a little bit slower. But again, still, slow growth is still growth. And we're not in a recession. And then China is slowing a little bit, but we'd all love to grow as fast as China's growing. So that continues to create opportunity. But so just looking at the data's pretty good in the U.S., a little softer in Europe and Asia. But then you get to the sentiment. And people, as you said, you can't technically talk yourself into a recession, but it seems like people want us to really talk about sort of all the data with a half-empty perspective. And that's an interesting dynamic because one day a data point is half empty and the other day it's half full. So there's a big swing in sentiment, but if you just look at all the troubles, whether you look at the trade tensions and trade policy, whether you look at Brexit, some of the elections around the world, oil supply chains being disrupted, inverted yield curves. There's enough stuff that I think give people pause. But the good thing I will say is you can't really talk yourself into a recession. Certainly from a Morgan Stanley perspective, recession's not the base case that our research team has. They actually, for the next 12 months, think there's only a 20% chance of recession. Again, when you say that, people go, 20%, that's high, but actually the normal percentage for a recession in any given period is 15%. So again, I think we're pretty sanguine about certainly the U.S. economy.
So I think maybe you want to say a little bit about, because you're doing a little bit of hand-holding here. You're saying we don't want to talk ourselves into recession. So people have concerns a little bit about the contribution of the trade war. What are we calling it? Trade conflict, certainly tough negotiating going on. And what's that doing to the economy, and how superficial or deep is that?
Yeah. Well, again, I think it has the potential to be really impactful. We like to refer to it as trade tensions. But clearly, it is impacting supply chains. It's impacting how people think about the future, whether they want to make big investments, given some of the uncertainties. But the ultimate pivot is, as I said before, certainly in the US, the consumer drives the economy, manufacturing less so. But when manufacturing and business confidence starts to weaken, and profits start to weaken, and earnings start to weaken, what you see is a transmission mechanism into jobs. And if people start laying people off, you get into this cycle where you'll lose business confidence, unemployment will go up, and you'll sort of enter into a recession. And I think that's the ultimate fear. I think people are quite hopeful. This one's a little tricky to call, given some of the negotiating style that we've seen. But people are quite hopeful that there'll be a deal with China sometime in the near to mid-future. It'll be a deal that works for both economies and will sort of avoid some sort of big trade dispute.
So how well prepared do institutions seem to be for if there's an escalation in the trade tension and trade tension, we're calling it?
We're going to call it tension. So I think this is the hard part. You can only be so prepared for things like this, and I think this is why sentiment has a tendency to sometimes shift quickly, because you're trying to make long-term decisions. And so if you're going to think about making an investment or buying a company or putting a plant somewhere, these things you can't pivot that quickly to move against. And trying to probability weight, if you will, the outcome of a negotiation or the outcome of an election or the outcome of a very binary event is very, very hard. So I think businesses are trying to do what they should be doing if you're going to enter into a more challenging environment. They're making sure they have proper liquidity, good inventories, but they're going to have to see how this plays out, because this is not going to be a quick switch one way or another.
Well, and I think you've said that what business loves, and particularly the financial community loves the most, is a sort of predictable economy that you can make long-term plans, and we're just not quite there at this point.
No, I think that's right, and I think that's the issue. I mean, even for someone like for Morgan Stanley, or for all of you in the important roles that you play, things are constantly changing, and when rule sets change, people are very smart and they'll adapt, but they need certainty. They need to understand what the guidelines are, what the rules are, what the outlook is, and with that as a backdrop, you can make very confident decisions. And if you don't have that backdrop, I think that's what some of the negative sentiment comes from.
So 2008 is a time that, even when you couldn't cut compliance, there were cuts in compliance. That was a tough recession at financial institutions. Can you tell me a little bit about what Morgan Stanley's, what's the post-crisis, world that we're in now? What's the business model that's sort of different than that 2008 stuff?
Sure. Well, it's dramatically different, as it needed to be. Coming out of the crisis, first of all, going into the crisis, we actually were regulated by the SEC. They were our primary regulator. Coming out of the crisis, we were regulated by the Fed as our primary regulator. Slightly different dynamic in terms of regulation. But coming out of the crisis, we had a seriously impaired balance sheet. We had a seriously impaired business model. We had the implementation of Dodd-Frank, which had a significant series of rules and regulations, including stress testing, resolution planning, living wills, liquidity requirements, all for the good, mind you. But when we came out of the crisis, we were clearly not in a healthy spot. We actually owned a half-built casino in Atlantic City, so that's not one of our better risk decisions that we made. But we no longer have that.
Well, you weren't the only ones with connections to Atlantic City and casinos.
That is true. But we spent the next sort of 3 to 4 to 5 years doing a whole host of things. One, just cleaning up the balance sheet, dealing with sort of issues of the past, legacy issues of the crisis, getting out of businesses that we shouldn't have been in probably. But given some of the growth that we were seeing, we had sort of expanded outside of our core competencies. So we clearly cleaned up the balance sheets. We cleaned up capital. We cleaned up liquidity. We cleaned up risk. And then we did something which was critically important to our success, which is we bought Smith Barney, which we merged with our existing company, and that sort of totally pivoted our business away from predominantly being an institutional global securities firm to a wealth management and an investment management
An
firm.
asset gathering firm.
Yes,
rather.
absolutely. We manage $2.6 trillion for individuals today. Over $1 trillion of that is in managed accounts, so a fee-based flow of revenues and earnings, which are a lot more predictable and a lot sturdier and steadier. And so we've sort of pivoted from predominantly a sales and trading business to a sales and trading business, clearly still core and very important to our company, but also a wealth and investment management company. And now we have about half of our business coming from that, or those two entities, or those two exercises, and our institutional securities group still makes up the other half. But a much different place. We've doubled capital. Going into the crisis, we had $34 billion of equity. Today, we have over $72 billion. Going into the crisis, we had less than $50 billion of liquidity, which was clearly not what you wanted to be. That liquidity was short. It was very durable. Today, we have over $200 billion liquidity pool with term and duration, so a much healthier and better spot to both for our employees, but certainly for our clients and our individuals.
Well, it sounds good. It sounds like a big place to be. So that makes me think, what are the things that you still worry about it that keep you awake at night?
Other than my wife, she's a terrible sleeper. She is a terrible sleeper. I'm supposed to tell you.
Does she get on the cell phone at night too? She's looking at messages. Never mind, we won't go.
So,
It's my life.
as a matter of policy, when I got this job, I was told that I'm supposed to tell everyone I sleep well always. Because
Yes,
I'm not supposed to, which I actually.
That's an economic indicator now
Correct.
that you're in this job.
Correct. I actually do sleep quite well. I'm constantly exhausted. It's interesting because there's obviously a whole list of things that I just talked about that you can worry about, and you can worry about all of them all day. But you try to focus on the things that you can control. Try to make the good decisions based on the best information you have. But I think the biggest risk that's the hardest to put your hands around, that I think I worry the most about, clearly still has to be cyber. The cyber risk.
Cyber hacking particularly, or cyber
everything
security?
About it. Cyber security, our data, our systems. We're a global firm, 24/7 trading and advising clients and corporations around the world every day, every minute. So systems going down, data getting leaked, people getting into your networks and doing real harm. And certainly pre-crisis, I don't think that was something we spent a lot of time on. Actually, people always ask me the biggest difference in technology. When I started at Morgan Stanley 25 years ago, we had beepers. So that's a big change. But the whole cyber threat is real. Clearly, we've seen it do real damage. When we started, we probably didn't have very much of a cyber budget at all. We clearly now spend close to $400 million a year on cyber. That's from zero. We can clearly spend more. We try to be very diligent about how we spend it, where we spend it. We've been investing significantly in fusion centers. We have now 4 fusion centers around the world that follows the sun: New York, Baltimore, Glasgow, and Singapore, that literally monitor everything that happens in and around our plant and our business every minute of the day. So it's a real risk, and it's a real threat.
That's kind of fascinating. So a fusion center, maybe you could say just a little bit more. People in this audience right now, we're all grappling with sort of what had been traditional AML and where it now fits into bringing together fraud and IT, and increasingly everybody here is trying to find a role for themselves that at least addresses those things. They particularly have responsibility for filing suspicious activity reports, if I can say that quickly. SARS. Yes, SARS. There we go. About this stuff. So tell me a little bit more about the Fusion Center. And is it like they're all 24/7 in each of these places?
Yeah, well, we do follow the sun, but they're manned constantly. And literally, it's like walking into, I don't know what it's like walking into a fusion center. I mean, we're monitoring email traffic, people trying to, when they put in passcodes that don't work, flows of trade settlements, email traffic, just everything that goes on within Morgan Stanley. And you mentioned, obviously, there are other areas around compliance that are also key focus areas for us. And the team that we built around that over the last decade, again, dramatically different where we were before the crisis, and trying to build both a combination of technology with the right level of insight and compliance and people and governance and controls around that. So, this idea that everyone's going to be replaced by technology is just not true. Right. Trust me. These are slow-moving, although technology is changing everything very quickly, but these are slow-moving trends. We still need smart, diligent, earnest people to make sure that we're doing things right and we have the right controls and governance around it. We've tried to create an environment of transparency. One of our core values is do the right thing, so having that ability to raise your hand saying something's not right, having the hotlines, having the right focus and attention. All the hotline calls, whether they come in through technology or the phone, report up to the board. We share all of that information with the board. So from the top down, a very, very strong focus on doing the right thing, compliance, and just making sure that we're making the best decisions we can.
And I would imagine that the fusion centers and a lot of what you're doing, that increasingly you're investing in and looking at, which everybody here is certainly thinking about artificial intelligence and how you're doing that. And I think everybody's struggling with what's a good investment now in that and what's the experimental investment that you need to make, but it's not quite there, all of that stuff. And
yeah, those are difficult decisions to make. We're clearly, let's just step back for a second. Technology broadly is both a potential threat, as we talked about cyber. It's a potential threat to some of the revenue streams in our businesses, but it's also an enabler. And whether that enabler is through automation, artificial intelligence, better data mining, reduction of error rates, all of those things, technology does really have the ability to change both the front and the back of what we do. And we have a significant technology budget. We spend roughly $4 billion a year on technology. That's both run the plant, change the plant, innovation, all of the buzzwords that you could possibly imagine. I try not to use them because if you ask me a question what they mean, I'll just say something else. But we are trying to use technology both as a front office revenue generator, but also as a back office to make it more optimized and more efficient in what we do. And when we enter environments like this, your comment about budgets and whatnot, where the revenue environment might be more challenging, technology is a tool to drive efficiency so we can sort of self-fund the investments we need to make, whether that's a business investment, a compliance investment, or a technology investment.
Well, I think when we talk about technology, this leads to another thing that's very much a concern of people in this audience and the regulators that are going to come on stage after us, and that is financial technology that's led to all kinds of innovations in payment systems and ways of moving money. Where's Morgan Stanley with all of that, and how do you look at that world?
Yeah, well, it's a big world, and it's one of those topics that everyone wants to talk about, whether it's technology or fintech or big tech, because it's probably more interesting than banking, to be honest with you. It certainly has more appeal. The interesting dynamic, and I think one of the reasons why people talk so much about it, I was looking at something the other day. In the last 5 years, there have been 10,000 venture capital rounds into financial technology companies. Wow. Over $300 billion has been invested in companies sort of that fit this fintech name. And so I think there's just a lot of buzz and energy around technology. Adoption rates are obviously skyrocketing. The pace of change is accelerating. So there's just a lot that you can talk about when it comes to technology. But again, it's an enabler, but it's also a disruptor. But one of the interesting dynamics is everyone thinks that technology is a new phenomenon, right? If you go back 10, 12 years ago, our equities business, it was basically a paper-based, phone-based business. We now have the largest equities business in the world for the last 5 years, generates somewhere between $8 and $9 billion of revenue, and probably 98% plus of what it does is electronic. So technology has been disrupting companies for a long time. Look at wealth management, right? The day traders, Schwab, TD Ameritrade. These companies were formed 20 years ago. There was a CEO when I started in the business that referred to banks as dinosaurs. Fast forward 30 years, we're still
there.
We're still here, and we're sort of the incumbents. So the interesting dynamic, I think that the dialogue has shifted. So 5 years ago, when I took the job at CFO, people were saying that FinTech was going to eat our lunch and we were going to go out of business. Right? Today, FinTech realizes they can't scale that quickly. Certainly, some of our businesses are highly regulated, and so now they are becoming partners of ours. They see our revenue streams, they see our clients, and they want to partner with us. So we're using their technology to help our businesses. The one area that we've seen real disruption, if you will, is in the payment space. We're not in the payment space, so it hasn't necessarily disrupted our business model. But clearly, there's a lot of traction and a lot of very large, successful companies in that space. When you start to look at, unsecured lenders or robo-advisors, those companies are generally pretty small, and they haven't really disrupted what we do. We've generally, as I said, adopted some of their technology, tried to enhance the customer experience, make things simpler, a little faster, and I think we'll be able to continue to do that.
Well, it's interesting, as you said, they're disruptive, but they're not quite there yet, and you've adopted some of their technologies. Maybe say something about that for a minute or two, if we can. Just, is there a FinTech strategy? How much can Morgan Stanley, how much do you need to adopt that new technology and change and be something a little different?
Yeah. Well, again, on the front end or the business side, I think we'd like to try to continue to innovate what we do and how we interact with not only our clients, but also how we create the advice and some of the work that we do for our clients. So how we make decisions around investment ideas, portfolio construction, all the things that we do. We might be using technology differently to come up with the creative ideas, and then also how we present that to our client base. So on the FinTech side, the one thing that people also, again, there are certain industries that get disrupted very quickly. We all know about them. But financial services, given the highly complex nature, the scale, the capital, the regulation, it's not so easy to disrupt these spaces. We have 3.5 million households that we provide wealth management advice to. They're all not going to wake up, today, Monday, and decide they no longer want to talk to their financial advisor and they only want to do stuff through their phone. It just doesn't work that way. So what we have to do as senior executives is to make those investments so as people's habits evolve, that we'll be in a good position to help them.
Well, this is an interesting question, or you've raised, I think, what's an interesting question. Is there going to be a division, too, between let's say, your older customers and the millennials and all that are coming up, and there has to be a plan perhaps for them? I've seen presentations that say that millennials don't want to talk on the phone to anybody, that they really want to do it. And I think that's an exaggeration, but it's based on something.
Yes, no, I have some that live with me. They clearly want to talk on the phone when they need money, which is an interesting dynamic because we have a wealth business. Mm-hmm. And the one thing that, you hear all the attributes about millennials. You've been told that they want to affiliate with brands that matter, that they want new experiences every couple of years. They're very conscious about the environment. The other consistent theme about millennials, they don't have wealth. So it's very hard to build a company for a universe that doesn't have wealth. But what we need to do is start to generate relationships with them and help them build their wealth so when they're in a position to need our services, we're there. And we did a really interesting acquisition earlier this year for a company called Solium, which is a stock plan administrator. But what it does is it provides corporations the technology, SaaS technology that they need for their employees who have stock-based compensation. Mm-hmm. And now we own that company. We've rebranded it Morgan Stanley at Work, and it's a way for us to have a relationship with younger employees as they build wealth. Because in this country, most people build wealth in their at their jobs. And so we're now have access to 2.5 million employees. We're going to be able to provide them with investment advice, financial wellness, and other things to help them accumulate wealth over time. So even though I joked about the fact that our model is a financial advisor model, so there's an FA in the middle of the relationship, we are also having a new direct channel, so to hopefully help us position us with this new cohort of people as they accumulate their wealth.
Interesting. Tacking a little bit on topics, can you talk a little bit about the importance of diversity in putting together a financial institution and what that means for Morgan Stanley? And I mean, this seems to have been such a change in the world over 20, 30 years, and one that's kind of brought a new dynamism and excitement.
And excitement, I think, is the right way. I think there's clearly lots of data that proves that diversity of thought, diversity of population, diversity of backgrounds help companies. So that's not an issue. And so we at Morgan Stanley believe very much so in diversity, and we think there's very important things that you have to do, which is you have to keep it top of mind, you have to talk about it, and you have to show your employees and your employee base that it's important to you. And whether that's through board representation, senior management, we've done a much better job of having a senior diverse population. We are talking about it at the operating committee. We talk about it at the board. We set targets to make sure that we have a good, strong, diverse population around the globe. And it's become one of the sort of core values of our firm to do the right thing and make sure that we're representing the populations that we work in, to give back to our communities. We partner with our HR department and our diversity councils to make sure not only that are we attracting real diverse talent, but that we're retaining the talent. Because I think we've done a very good job of bringing people into the firm, and now we're doing a better job of making sure that they feel that they have a seat at the table and that their voice can be heard.
Certainly, yeah, the culture in broker-dealers has changed a lot. I actually covered broker-dealers way back, and it's not quite in trading desks. I used to call trading desks, and let's say, I think a lot of that culture has been muted. And
yes, well, I mean, certainly, absolutely. We have 4 core values at Morgan Stanley. Client first, lead with exceptional ideas, do the right thing, and give back. And I think that's really, when you think about, a lot of people ask me, what does it take to be at Morgan Stanley? I said, we're looking for sort of hardworking, smart, earnest people. And that's really true. And I think if we can build a firm where people feel a sense of belonging and they feel part of a broader team, that will go a long way.
So we started out finding out that you didn't set out to be an investment banker or CFO, and here you are. Mm-hmm. What has surprised you about this? And I guess I want to say, what has surprised you? And what do you think the audience might be surprised? I mean, we all have to live with CFOs. So what do you think the audience might be surprised about what surprised you and what would surprise the audience about being a CFO at such a large, august firm?
Well, thank you. Listen, I think that the most surprising thing to me, again, as a banker, you're sort of analytically driven. You're trying to look at the data. You're trying to advise clients when and how to do things based on data, and it's all sort of rooted in data. And I think this sentiment and sort of what drives markets and what drives fear and what drives people to make decisions that they make has really been the biggest surprise to me. I took over as CFO in May of 2015. I think we had one of our best quarters ever. Economy was good. Everyone was excited. And then somehow we started going into the end of 2015, and everything changed. Not internally, but externally. People were talking about European banks failing and China hard landing and geopolitical risks around the world, and the markets were going crazy. And I think the next panel is a regulatory panel. We have regulators. We're obviously highly regulated, but we have regulators that are in our building. I talk to regulators all the time, and they constantly during this period would call me and say, what are you seeing inside of Morgan Stanley? So I would be looking at credit spreads and liquidity and pipelines and sort of all these level of activities, and inside our pipes, everything was the same. But outside, the market was going crazy, and people were just, again, this sentiment shift that all of a sudden it's the sort of the straw that breaks the camel's back. Somewhere there's a tipping point, and people go from positive to negative with not a lot of different data. And then if you remember, fast forward first quarter of 16, sentiment shifted again, and we were back sort of more in a positive tone. So this sort of sentiment shift, I joked, I still cook a lot. I like being creative, but I am a data-driven guy, and sort of I look at data and try to say, if this is the data, this is what should be happening. And you don't always get that outcome with these markets.
Well, I wondered if you'd all please join me in thanking John Pruzan for being here today.
Thank you.